Hey there, fellow investing iguanas. Have you ever found yourself looking at CSE Global's stock here in Singapore and wondering, this looks solid and pays a healthy dividend, but why isn't the price moving much? Or maybe you're asking if it's time to buy, hold, or just move on to something else. Today, I'm going to break down exactly where CSE Global stands right now, drawing from my latest deep dive on Substack, with 3 big positives, 3 major red flags, and my latest verdict for Singapore investors, especially if you're putting CPF or SRS funds to work. But first, a quick intro for those new here. I'm Iggy, your investing iguana. I take a deep look at SGX companies, peel back the jargon, and share what actually matters for Singaporeans building their portfolios. I always try to make this stuff so simple an O-level student could get it on the first listen. Here's what's coming up in this video. I'll start with a quick overview of CSE Global and why it matters right now. Then I'll break down the 3 biggest positives in their business, followed by the 3 warning signs you should know. After that, I'll walk you through what would make me change my stance on CSE, share my personal verdict and how you might want to position this stock in your CPF or SRS account, and close with some key lessons you can take into your own investing journey. Let's dive in. CSE Global, listed as SGX 544, is a Singapore-headquartered systems integrator. That means they design and maintain control and communications systems for big industries like energy, infrastructure, and now, the rapidly growing world of data centers. Their business is split into 3 main segments: electrification, communications, and automation. What grabs my attention these days is how management is pivoting toward US data center opportunities, even as they win fresh projects here in Singapore. This is why CPF and SRS investors should care. CSE Global's growth looks set to ride the wave of digital infrastructure, both at home and overseas. In the most recent half-year results for 2025, revenue increased by just under 3%, hitting nearly 441 million Singapore dollars. Net profit jumped over 8%, reaching $16.3 million. The order backlog remains solid, and the dividend is holding steady, which is music to most Singapore investors' ears. But there is a twist. Most of CSE's earnings come from outside of Singapore and are reported in foreign currencies. So if the US dollar or Australian dollar takes a dip, your SGD payout might shrink. Breaking down their segment revenue for the first half of the year. Electrification, that's power grids and similar systems, brought in about $222 million, which is just over half the total. Communications, which covers telecoms and data centers, accounted for almost $119 million. Automation came in at $99 million. Communications is the fastest grower, thanks largely to big wins in the US data center market. That's a strategic shift you don't want to miss. Now, why do some investors see CSE as a bit of a value trap? It's because on paper, growth and dividends look good, but the share price stays flat and volatility can spike at odd times. So, let's get into my 3 positives and 3 warning flags. First, the positives. Number 1. Communications growth driven by the data center boom. Communications revenue jumped almost 13% in the first half of this year, thanks to acquisitions and fresh contracts, especially in the United States. Picking up Chicago Communications was a big move, opening up 4 new states and direct access to the massive US data center industry. Keep in mind, Singapore's own data center sector is heating up. Government policy is helping digital investments take off, and CSE is very much in this space, both here and abroad. My tip, keep an eye out each quarter for new data center contracts in both the US and Asia. If those numbers keep rising, earnings will stay resilient, even if things slow down in Singapore. Number 2, a strong near-term order book. While the total backlog fell about 17%, it's still at nearly 574 million Singapore dollars. That's enough to cover about 1.3 times CSE's annual sales, so short-term visibility for investors is solid. The Americas contribute the lion's share, with Asia Pacific and EMEA making up the rest. Almost all the revenue now comes from their so-called flow business. That means ongoing service and maintenance instead of risky, one-off, mega projects. That recurring revenue makes profits and dividends more stable. Here's my advice. Every quarter, check that new orders are keeping up with recognitions. If the backlog stays flat or rises, dividends should be safe. If you notice the backlog shrinking quarter after quarter, it could be the canary in the coal mine. third, and this is a favorite for income seekers, a stable CPF and SRS eligible dividend. CSE Global hasn't missed a payment in years and just paid out an interim dividend of 1.14 cents, which is down slightly from last year but still notably steady. The forward yield is about 3.6%, beating most SGX tech peers and even some local REITs. However, the payout ratio is sky high at 98%, meaning there's almost no cushion to grow that dividend in the future unless profits rise. As a CPF or SRS investor, you want some stability for retirement, but also enough headroom for growth. So compare CSE's yield and track record with your other options next time you rebalance your savings. Now let's pivot to the three major red flags. First, CSE is at the mercy of foreign exchange swings. With most profits earned in the US and Australia, every move in the dollar or Aussie dollar impacts the bottom line. This year, a dip in the US dollar cut electrification revenue by nearly 1%. Automation took a similar hit. As an investor earning and spending in Singapore dollars, currency risk means even good business performance overseas might not show up as growth in your pocket. My tip: watch USD to SGD and AUD to SGD trends every earnings season. It'll help you separate business performance from currency noise. Second, rising costs are squeezing margins. Operating expenses grew by almost 6%, or about 6 million Singapore dollars in the first half of the year, faster than revenue was growing. Higher payroll, more expensive office space, and charges for business integration all cut into profits. Margins fell from just over 10% last year to 9% now. Compared with peers, CSE is more leveraged and its payout is among the highest. High leverage is double-edged in a downturn. So look out for the trend in operating margins. If sales are rising but profits are flat or shrinking, it's a signal that costs are eating into what should be your payout. Last of the three, the high dividend payout leaves no room for error. Nearly all profits go out the door as dividends, and with net debt at 2.5 times EBITDA, there's little buffer. If profits slip, the company either has to cut the dividend, raise fresh capital, or borrow more, which is riskier when rates are high. We've already seen the interim dividend trimmed this year. As an investor, don't just look at the headline, profit. Dive into free cash flow after dividends. If there's little left, that's a warning sign for dividend sustainability. So what could change my mind on CSE Global? On the upgrade side, if the order book jumps above $650 million by year end, or if we see 2 quarters with profit margins above 10%, I'd be a lot more optimistic. Seamless integration of the Chicago acquisition or a mega data center project win, think more than $50 million in new contracts, would definitely move the needle. On the other hand, if the backlog falls below $500 million, or margins dip below 8% for 2 quarters, or we see a surprise dividend cut or urgent capital raise, those are clear warning signs. A sudden loss of a top customer would also be a reason to reassess fast. For now, here's my view. CSE Global is a solid holding if you want steady income for your CPF or SRS and aren't chasing explosive growth. The data center boom and US expansion could boost returns, but the high payout ratio, cost pressures, and unpredictable FX swings mean you want to keep your position size reasonable. For new buys or top-ups, I'd look for a share price between 60 and 68 cents to give yourself a margin of safety. Always keep an eye on the backlog and profit margins. Big data center wins or large currency swings will tilt the scales, so track them each quarter. In short, I'm neutral. Hold if you're in for income and stability, size your bet carefully, and don't expect fireworks. That's how I play it with CSE in my own retirement planning. Before we wrap up, let's pull together the key takeaways. CSE Global offers stable dividends and modest tech exposure. Good for CPF and SRS portfolios, but profits can swing with US dollar and Aussie dollar exchange rates. The growth in data center business is promising, but it comes with risks around execution and margins. Always focus on the order book and profit margins as your main signals for company health. An entry price below 68 cents feels fair, but remember, with almost all profits paid out, next year's earnings will set the pace for future dividends. If you want stable income, size your investment accordingly, keep a close watch on exchange rates and company updates, and review your position with every quarterly report. Thanks for sticking with me, Iguanas. If you found this breakdown useful, please give the video a like, share it with fellow investors, and tap subscribe for more clear and actionable takes on SGX stocks. If you want all the charts, checklists, and my full thesis in writing, check out the deep dive on Substack. There's also a link if you want to go premium and get early access to my portfolio moves and special research. Finally, if you want more on dividend and data center stocks, be sure to check out my video on how to vet SGX yield stocks for 2025. Should be popping up next. Take care, invest smart, and I'll see you next time.